The Minority Market. Episode 39. Risk per trade and position sizing explained. Most traders focus on how much money they can make. Very few focus on how much they can lose. This is why most accounts do not survive long enough to grow. Risk per trade and position sizing are not advanced topics. They are survival tools. Without them, even the best strategy will eventually fail. Risk per trade simply means deciding in advance how much of your capital you are willing to lose on a single trade. It is not based on emotion. It is based on rules. When you do not define this, the market defines it for you. And the market is not kind to emotional decision makers. Beginners often risk randomly. Sometimes they invest big because they feel confident. Sometimes they invest small because they feel afraid. This inconsistency destroys long-term performance. The minority uses fixed risk rules. They protect capital first and think about profit second. Position sizing is how you translate risk into actual trade size. It answers the question, how many shares or lots should I trade based on my risk limit? Without position sizing, traders either overexpose themselves or underutilize capital inefficiently. Another common mistake beginners make is using the same trade size for every setup. They ignore stop distance and volatility. If your stop is wide, your position size should be smaller. If your stop is tight, your position size can be larger. The minority adjusts size based on risk, not emotion. You must also understand that risk is not just about money. It is also psychological. Large position sizes create emotional pressure. They cause fear, hesitation, and impulsive decisions. Smaller, controlled risk keeps the mind calm and focused. Emotional stability is a competitive advantage. Another dangerous habit is revenge trading. After a loss, beginners increase position size to recover quickly. This behavior often leads to larger losses. The minority never increases risk emotionally. They maintain consistency regardless of recent outcomes. You should also understand drawdowns. Even good systems experience losing streaks. If you risk too much per trade, a small series of losses can destroy your account. Controlled risk allows you to survive bad periods and stay in the game. Another important concept is compounding protection. When you preserve capital, compounding works in your favor. When you take large losses, compounding works against you. A 50% loss requires 100% gain to recover. This math alone shows why risk control is essential. Many beginners dream of fast growth. They take high risk, hoping for big returns. This usually ends in account wipeout. The minority accepts slower, steadier growth in exchange for long-term survival. Risk per trade also creates decision discipline. When you know your maximum loss before entering, you stop negotiating with yourself during the trade. You stop hoping. You stop panicking. You follow your plan. Another benefit is confidence. When losses are controlled, they stop feeling catastrophic. You become emotionally resilient. You stop fearing the next trade. This stability improves performance more than any strategy. You must also understand portfolio risk. When you take multiple trades, risk can accumulate. If all positions are correlated, your total exposure becomes dangerous. The minority monitors overall risk, not just individual trades. Another mistake beginners make is ignoring volatility. When markets are volatile, risk increases. Stops need to be wider. Position size should be reduced. The minority adapts to changing market conditions. Here is a simple framework. First, decide your maximum risk per trade. Many disciplined traders risk a small percentage of capital per trade. Second, calculate stop distance based on structure. Third, calculate position size based on risk and stop distance. This ensures consistency. Another powerful habit is keeping risk constant even when capital grows. This prevents emotional overconfidence. As your account grows, your position size increases gradually, not explosively. This creates smooth growth curves. You should also understand that risk management is boring. It is not exciting. It does not create social media highlights. But it creates longevity. The minority values boring consistency over exciting losses. Another psychological benefit is reduced attachment to outcomes. When you know loss is limited, you stop caring emotionally about individual trades. You start thinking in series of trades, not single outcomes. Professional traders often say this: take care of risk, and profits will take care of themselves. This is not motivational talk. It is statistical truth. Survival comes first. Growth comes later. Here is a mindset shift you need to adopt. Instead of asking, how much can I make? Start asking, how much can I afford to lose? This single shift changes behavior dramatically. Another exercise is reviewing past losses. Calculate how much damage poor risk management caused. This builds respect for risk rules. The minority understands that the market is unpredictable. What can be controlled is position size and risk exposure. They focus energy on controllable variables. When you master risk per trade and position sizing, you stop gambling. You start operating like a professional. You protect capital. You protect mindset. You protect longevity. This is why risk management is not optional. It is the foundation of survival. And without survival, no strategy matters.